part one of the series. Today we're talking about servicing, and this is the calculation that lenders will do to work out how much money you can afford to repay. They're going to take into consideration your income, any expenses, plus your cost of living. So we'll go to the first example, and in this example we're using a gross annual income of $60,000. First thing we'll do is convert that to a net income after tax, and that gives you $48,000 basically to have available to repay a loan. Lenders will work on a monthly cycle generally as a rule, so we'll convert that to a monthly figure of $4,000 per month. Now, the first thing we're going to do is work out your cost of living. So most lenders have a cost of living calculation. They've already applied to their income, and they work out what the average cost of living is per person. Now this will vary between individuals, and it doesn't take into consideration any personal expenditure or external other costs that may not be calculated. For instance, as insurances or perhaps school fees if you're going to doing extra schooling yourself, or any other cost that's not considered as part of the normal cost of living. So then keep in mind, this is a minimum, so we really need to be cautious about how we apply the figure. But in this example, we're using your $4,000 net income minus your cost of living, leaves us $2,856 per month to service the loan. So using that as a base guide with one of our major lenders, your borrowing capacity is $409,000. So that's the maximum loan amount you could have based on that income. That's not the purchase price of the house, that's just the loan amount. However, if you have a $5,000 credit card and a car loan with a repayment of $600 per month, you can see that based on that same information, your borrowing capacity is reduced to $316,000. If you happen to have a child who's dependent, then the cost of living increases and your maximum loan amount is reduced to $269,000. And if you happen to be married and have a child with the same information, your cost of living is further reduced to $126,000. So that's an example of why it is for married people, recently married families with a young child, makes it very hard to buy a house because they don't have the income to service the debt. So ways we can improve your income, well obviously if you do have a dependent child, family allowance can be taken into consideration by most lenders as long as a child is 11 years of age or younger. Some will go to 12, some will go to 16. Credit card. Now the credit card is the limit. So if you have a $10,000 limit and zero owing, the lender will always take into consideration the $10,000 because that's the debt that you can get into. So if you have a $5,000 credit card limit and only owe $1,000, then you can look at reducing the limit to $1,000 because that will improve your borrowing capacity. Car loans is the biggest trap for most people. Everyone seems to have a car loan. That will hugely affect your borrowing capacity. So a way to improve your borrowing capacity, for instance, would be to refinance the car loan and put it back over 5 years. That will decrease the monthly commitment. Now it might not be particularly financially smart because by increasing the loan term it actually increases the amount of interest that you have to pay on that loan. But if it decreases your monthly commitment, it might actually allow you to borrow enough to buy the house that you want and get out of the rent cycle. So there's a lot of variables in this, and obviously the greater the income, the greater the borrowing capacity. And the other thing to remember is that with the loan repayments, lenders will calculate the repayments at either 1.5% or 2% higher than what the actual repayment is. There's an inbuilt buffer that they apply so that if rates go up, you don't automatically, the loan doesn't become unaffordable. So I suppose the greatest advice I can think of and to give is to calculate your own borrowing capacity. So work out what you can afford to repay every month, regardless of this, because 9 times out of 10, most lenders will probably let you borrow more than what you can afford to repay. So use that as a starting point. For instance, if you're paying rent and you're not saving, then we have to use your rental figure as a basis for what you can afford to repay. If you are paying rent and managing to save $100 or $200 a week, and we add that $100 or $200 a week toward your rental repayment, and we use that as a basis to calculate what you can afford to repay. And then hopefully everything else stacks up and it all works out. Hope you enjoyed part 1. Stay tuned for part 2. We're going to talk about the amount of funds that you need to buy a house.